All right. Talk really quick about the economy. So the Fed raised rates. I said this in my last NASDAQ video. I don't think this is going to end well. I think what the Fed is doing now, excuse me. So I don't think this is going to end well. I think what the Fed is doing now is picking the market over the value of the dollar. And I'd hope that they would pick, when it came to it, that they would pick the value of the dollar because that is what I think, that is what makes, from an economic standpoint, from a finance standpoint, that is what makes America a global power. And it feels like he's picking the market. He wants to ZERP into existence some more money. They're going to ZERP that into existence and I guess keep the market elevated. I should have drawn a picture. The way I view the market at this point is imagine a ladder propped up against a house. And the guy on the ladder keeps going down and then keeps readjusting the ladder so that it higher and higher and higher on the house. But then replace that house with just a house of cards. And that's what's happening, right? Trying to juice this market to 50K on the Dow, to 25 or 26 or wherever they want to get on the NASDAQ. It's just, it is resting on a house of cards. And the thing is, the higher it gets, the more volatile the crash will be. I will say this, we should have allowed a orderly crash with SVB and Signature and use that as the inflation reset, the controlled recession trigger instead. And again, I said this in my last video. I think why they didn't do that is because Yellen and Jerome Powell realized the emperor doesn't have any clothes. And that was my kind of emperor doesn't have any clothes moment when that happened, because I didn't think there was a need to bail those two out the way they did, to change the FDIC limits from 250K to infinity. Like the measures he announced that Sunday night were so drastic. I was kind of like scratching my head like, wait, I thought it was just two banks that were going under and you were just going to hit up JP Morgan and BofA and the other big banks for some cash to cover them, to cover the deposits. And when he did all that other stuff, and then the market took off, right? I was just like, all right, the emperor has no clothes. He realizes that any dislocation in the market, and it's good night. The problem I see, and I know I'm rambling here, but the problem I see is that we were at like 10.6 on the NASDAQ when that happened back in March of 23. And we're at like 24, 20, I think 22, 23 now. So we went from 10,600 and then it just shot. There were a couple of dips in there with the tariff stuff, but shot right back up to 22, 23,000. And now, instead of that ladder falling from 10,000 feet, it's going to fall from 20, and it's going to fall. It's going to fall because you cannot build an economy on counterfeit money, and that's all that quantitative easing is. And when Jerome Powell signals that he is going to back the banks at any cost, then in my mind, and I know there are people much smarter than me, but in my mind, that turns ZERP into de facto QE. Because what he's telling the banks is, I'm not going to let you fail. Whatever loans you make, whatever your treasury portfolio looks like, whatever your investment portfolio looks like, if you are a big bank, top 20, 25, 30, and you're integrated enough into the global financial system, I'm not going to let you fail, which to me then turns all of those loans, those ZERP loans that they're going to be making into de facto QE. So I said this again in my last video. I'm just saying it here. Nobody can predict when these things will happen, but I can tell you when it does happen and when it turns over, it's going to be very, very volatile. It's going to be not a 10% or 20% correction. It's going to be a look up below type of moment. And I do think when that happens, that period, in the period of QE from 2008 up until whenever, I think will be studied in business schools and by finance and investor professors for 100 years, the same way we study the Great Depression. They'll study whatever we'll call this because they'll realize, like, you know what, you can't, a dollar bill is a store of value, right? It's an earned income store of value. And you can't just print those and put those, into production and say, well, it looks like the actual store value. And if it looks like the store value, then it's going to be a store value, and then everything is going to be okay, right? This market is I like to call it a fraud market that's built on QE. It's not built on earned income. And I don't know what the trigger will be, like I said in my last video, but there will be one. And when it is, and this market turns over, it's going to be, I believe it's going to be very, very bad, which is going to be unfortunate for Main Street. All right, I'm at 6 minutes now. I'm kind of cruising, but I do want to say this. It feels to me like bankers just don't learn their lesson, right? We did the whole, giving everybody loans back in the housing market crash. And then in addition to giving everybody loans, we doubled down on that and created this whole MBS fiasco. I think they said it was levered like 4-to-1 or something like that. And then we do this with QE, and we let QE spill. If anyone's interested in why crypto is going gangbusters, it's because there's $10.2 trillion of funding money out there that has inflated all of these asset classes. You look at Zillow, and you see right before COVID, there was a house selling for $250,000. And then 3 years after COVID, in the height of QE, that house is selling for $600,000. The same house, same neighborhood. And it's just, and then the bad thing is that in order to keep the market where they want it or keep it kind of going up, they just have to do more and 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 more. And like I said, I thought the prudent thing would have been an orderly wind down of SVB and Sovereign and take whatever hits you have to take. But we decided to continue to inflate and to bail out. And I think we're going to collectively pay for that with a very, very bad market crash.